Hello everyone. In this video, I will explain the incidence of a tax. That is, once the government imposes tax, who will bear most of the tax burden? Consider the standard demand and supply model, where quantity demanded is function of price, and the price is what the buyers are paying. On the other hand, quantity supplied is also function of price, but this time we consider the price suppliers are paying. We also impose the standard equilibrium condition that demand is equal to supply. However, tax is equal to the difference between the price buyers are paying and the suppliers are receiving. Let us perform the standard analysis using the demand and supply curves. We take quantity on the horizontal axis and price on the vertical axis. The supply curve is upward sloping and the demand curve is downward sloping as usual. Now, the market clearing condition ensures that demand should be equal to supply, and therefore we have equilibrium price given by P1 and equilibrium quantity given by Q1. If we think about the consumer and producer surpluses, then area above the price line below the demand curve represents the consumer surplus. On the other hand, area below the price line and above the supply curve represents the producer's surplus. So overall, welfare of the society can be observed by taking the sum of consumer and producer surpluses. Well, up to this point, things are pretty straightforward. Let us now consider imposition of taxes. Suppose the government imposes tax on the buyers, and this will shift the demand curve to the left. New equilibrium takes place at quantity Q0, which is less than Q1. However, the price at this point would be the price suppliers are receiving. On the other hand, the buyers are paying much higher price, which is denoted by PB in the diagram. We see that once the tax is imposed, there would be a difference between the prices buyers are paying and the prices suppliers are receiving. And that difference is in fact the tax, as can be seen from the equation here. We see that the tax is the difference between the price buyers are paying and the price suppliers are receiving. Overall, area A is the area or the tax contribution from the consumers, and area B represents the tax contribution by the producers. But what about the triangle that is between the old and the new equilibrium points? Well, this triangle AEF represents the deadweight loss. So from the consumer surplus, component C is the lost part. On the other hand, component D is the lost part from producer surplus. And that is the component C plus D, which is the overall deadweight loss, which is not going neither to the producers or the consumers or the government. That's why we call it a deadweight loss. Overall, we see that the tax revenue is equal to area A plus B. The deadweight loss is equal to area C plus D. And A is contributed by the consumers. Area B is contributed by the producers. The question arises that who would be paying most of the tax, or once the tax is imposed, who will bear most of the burden? Well, here comes in the role of elasticities. From this diagram, we see that area A is bigger than B, which indicates that the demand is less elastic compared to the supply, and that is why the most tax burden would be borne by the consumers in the market. Likewise, if the supply is less elastic compared to demand, then most would be contributed by the producers. Overall, the tax revenue is equal to area A plus B. So this completes my analysis of demand and supply model with taxes. Now think about subsidies, which can be considered as negative tax. If the subsidy is given to consumers, then it will shift the demand curve to the right. And then we will see that the new equilibrium will be established. How it changes the equilibrium price, quantity, etc., you have to perform the analysis reversing the roles. I leave it to you. Thank you very much.